Hi everyone, welcome back to Money.Finesse.Mindset. This is episode 10. You probably start your career in your early 20s. For the next 40 plus years, you focus on earning, saving, and investing so that by the time you retire, you have got a solid foundation to enjoy life. But the dream doesn't stop there. Imagine money showing up in your bank account like clockwork without lifting a finger. That is passive income in action. If you search passive income for retirement, you will find tons of content about dividends. Many promise an easy path to financial freedom and claim you can live entirely off them. But can it really be that simple? Dividends are cash payments to shareholders. A little thank you for investing in a company, mutual fund, or ETF, exchange traded fund. In the US, most pay dividends quarterly, though some do it monthly. International ones usually pay once or twice a year. To unpack dividends, it helps to know 3 key dates and 3 important numbers. Let's start with the dates. Declaration date. This is when the board announces the dividend, usually in a press release listing the ex-dividend date, payment date, and dividend amount per share. Ex-dividend date. This is the cutoff that decides if you qualify for the dividend. You will receive the payout only if you own the shares before this date. Payment date. This is the day the dividend deposited into your account. Now, the key numbers. Dividend per share. This is how much cash you receive for each share you own. Dividend yield. This shows how much a company or a fund pays in dividends each year relative to its stock price. Think of it as a snapshot of the potential return on your investment. Dividend payout ratio. This shows what percentage of earnings is paid out as dividends. Let's walk through a real example. Headquartered in Houston, Texas, ExxonMobil Corporation is one of the world's largest energy providers. It pays dividends 4 times a year. For simplicity, we will just call it Exxon going forward. On January 31st, 2025, Exxon announced a dividend of 99 cents per share payable on March 10th to shareholders of record by February 12th. That makes January 31st the declaration date, February 12th the ex-dividend date, March 10th the payment date, and 99 cents the dividend per share. Just a few lines in a press release cover 4 of the 6 critical pieces of information we have just discussed. Only 2 remain, dividend yield and dividend payout ratio. To calculate dividend yield, divide the annual dividend per share by the stock price. Exxon's press release shows the latest quarterly dividend of 99 cents per share. From here, there are 2 ways to annualize that dividend. Method number 1, precision. Add up the 4 most recent quarterly dividends. For Exxon, that totals $3.88 per share. Method number 2, quick estimate. Multiply the latest quarterly dividend by 4 to get an estimated annual dividend. For Exxon, that comes to $3.96 per share. With Exxon's stock price at $109.24 on January 30th, the dividend yield is 3.55% using method number 1 or 3.63% using method number 2. For well-established companies or funds with steady payouts, either method works fine. But if the payouts are irregular or fluctuate, the precise method gives a more reliable picture. Next, the dividend payout ratio. Exxon's estimated 2025 earnings per share is $6.58. Divide the annual dividend per share by earnings per share to get the dividend payout ratio. 58.97% for method number 1 and 60.18% for method number 2. Now that you know how dividend yield and dividend payout ratio are calculated, how should you make sense of them? Higher the better? Not necessarily. A very high dividend yield is not always a good thing. Sometimes a high yield just reflects the norm in that industry, not necessarily the company's strengths. For example, real estate investment trusts or REITs are legally required to redistribute most of their income as dividends. So high yields are normal. But a high yield can also be a warning sign, like a car with the check engine light on. The stock price may have dropped sharply because the company is underperforming. So while the yield looks high, it could be risky. A very high dividend payout ratio also deserves a closer look. It means the company is giving most of its earnings to shareholders, leaving less for growth, paying down debt, or getting through tough times. Ratios above 80% may indicate the dividend is less sustainable if earnings decline. So always ask yourself, why is this company or a fund paying so much? And how long can they continue? Remember, there's no free lunch. Once you start collecting dividends, you face an important decision. Take the cash or reinvest through a DRIP, dividend reinvestment plan. Let's walk through a quick example with Exxon to see how these two choices play out over a period of 5 years. Suppose you bought 100 shares of Exxon on October 12, 2020 at $34.65 each. By August 2025, if you took the cash, you would still have 100 shares. With the stock price at $115.29, your holding is worth $11,529 plus $1,741 in cash dividends collected along the way. If you reinvested through DRIP, your dividends bought more shares each quarter. By August 2025, you would own about 131 shares worth $15,080. Of that, $2,005 came directly from reinvested dividends. Looking at just the portfolio value, DRIP clearly comes out ahead. It demonstrates the magic and the power of compounding. Now imagine using DRIP for this Exxon investment for 20, 30, or even 40 years. You would earn more shares, more dividends, and even greater growth. On paper, DRIP creates a positive self-reinforcing cycle. That's why social media is full of content promoting the dream of living off dividends. But let's run some numbers to see if it is realistic. Suppose you want Exxon to pay you $50,000 in dividends every year. Roughly how much would you need to invest? Answer: about $1.26 million. Of course, this is just a back of the envelope estimate, and it depends on a couple of big assumptions. First, Exxon's ability to maintain its current yield and stock price. Sure, Exxon is a huge company with a strong track record, but no one can predict the future. What if it cuts or suspends its dividend? What would be your plan B? Second, taxes. Dividends come in two types: qualified dividends and ordinary dividends. Qualified dividends are taxed at a lower long-term capital gain rate, while ordinary dividends are taxed as ordinary income. In this example, the $50,000 from Exxon will be qualified dividends. Assuming a 15% tax rate, you would need to set aside $7,500, leaving you with less to spend. Where could you pull money to close the gap? From my own experience, I didn't reinvest through DRIP. Instead, I took the cash payouts and invested them across different stocks and funds. While I didn't benefit from compounding those dividends, I still earned excellent returns over the years. That's because many fast-growing, valuable companies, especially in technology, pay little or no dividends. By redirecting my cash dividends into them, I have kept my portfolio growing and well-balanced. Social media loves to hype up the idea that you can retire comfortably on dividends alone. But that's as unrealistic as trying to run a marathon without proper training. Dividends are a great source of passive income, but they are meant to be supplements. Using them as the centerpiece of your entire retirement plan is risky. Grow your portfolio, invest smart, and let your money work for you. Whether you reinvest dividends or put the cash to work elsewhere, your portfolio can keep growing, and you will be well positioned for a secure future. I hope this episode gives you a realistic perspective on how dividends can fit into your overall retirement planning. Take care of yourself and your finances. Remember, dividends can help along the way, but you are in the driver's seat. See you next time.